decision, and I did this yesterday for the Fed, and we're doing the MPC today. So same format, quick summary, even quicker than it was for the Fed because there's no press conference, and then I'll throw it over to you for questions. And we're starting at a more civilized time because this is Britain and there is no time difference. So let's start off with the decision itself, which was no decision, right? So they decided not to cut. Last time, remember, they had to have 2 votes because it was such a close decision. And in the end, they decided to cut. But this time, no decision to cut. There wasn't unanimity this time around, so it wasn't too far off. I mean, it was 7-2 in support of keeping it where it is. 2 members supported a 0.25% reduction to 3.75%, but the rest kept it at 4%. Now, clearly in the UK, the situation is we haven't got particularly strong growth. We have inflation ticking up. It seems to have peaked for now, as the Bank of England expected it would towards Q3 of this year, and they expect it now to start falling. So that's the inflation story, and certainly the kind of growth story in the UK is a lot weaker in the US. So in terms of the dual mandate for the Fed, they have to ensure full employment and also stable prices. For the UK, the focus is completely, at least officially, on prices. So it's about inflation. But they always have an eye to growth as well, of course, because, well, it affects inflation too. So what did they say? Rates would be the same, and they're going to reduce their gilt holdings. They're going to carry on reducing their gilt holdings. The big difference between the Monetary Policy Committee and the Bank of England and the Fed's response to quantitative tightening, which is when a hugely bloated balance sheet, which has been buying all of these government bonds to push down yields, now that's gone into reverse. The Federal Reserve just lets the bonds mature. So there's no selling of its huge stockpile of treasuries. So there's no question about distorting that market further. Whereas the Bank of England very actively auctions off its gilts. So that, they claim, hasn't distorted the market, but now they're going to slow down the rate at which those sales are going to happen. Of course, there's runoff for the Bank of England as well. Bonds mature, and then they can choose not to replace them. And that also shrinks the size of the balance sheet passively. But they have decided not to sell such a large proportion of long-dated gilts, because remember, the big worry at the moment is the big yield curve movements at the long end of the curve, you know, the 30, 40, 50-year bonds, even 20-year bonds. It's not so much about the short end of the curve, you know, 1 to 2 years maturity. It's all about the long end of the curve, and people spurning that debt, pushing up the yields and pushing down the bond prices. So what the bank has said is we're not going to sell so many of those long dated things. Previously about 1/3 of their sales were long dated bonds. Now it's going to be about 1/5. So if it wasn't distorting it in the first place, the market, then why slow down the sales? Well, it's a bit suspicious. Anyway, why have they decided to do what they did? Very quickly, obviously we've still got disinflation. There has been progress towards their goal of 2% inflation, and that's been a 2.5-year process from the big peak. They say that it's partly due to their restrictive monetary policy. Of course, they say that, but also less price shocks externally, which of course can't be controlled by monetary policy. And here, largely in the UK, we're thinking about energy prices. Our big input price into our economy is energy. We don't have enough made locally. We don't produce enough energy at the moment in order to be self-sufficient, although we are moving that way, of course, in terms of renewables. Second point, if we look at inflation right now, it was 3.8% in August. It's expected to increase slightly in September, and then they think it's going to fall towards their 2% target. So a little bit further to go in terms of the increase, but then it should fall back. Wage pressures were the biggie in terms of worries, and those have eased a bit, and there is a bit more slack in the labour market due to the weakness of the economy, but it's still pretty elevated. And remember, if you look at the triple lock in the UK, the triple lock for UK pensions, the state pension, 1/3 of that triple lock, the second lock, if you like, is wage growth, and that's the one that's going to be pushing up UK state pensions this year. So that's going to be 4.7%. So that's pretty chunky wage growth if you want to have inflation at 2%. So yeah, that's still pretty elevated. And I'll talk about a letter from Andrew Bailey, the governor of the Bank of England, to Rachel Reeves, the Chancellor, where he apportions blame. But we'll see that in a moment. Inflation risks, yeah, they're still vigilant. They always say that, and they think that wage growth obviously is a risk for the UK. That if wage growth stays high, that's going to embed higher inflation structurally long term. And things like food, weirdly, even though it doesn't form a large part of most people's consumption basket in the UK, psychologically it's very important, because what we perceive is the prices we pay for food. The stuff that we kind of just pay for by direct debit, we're not so sensitive to, strangely. So petrol prices, food prices are what we see every day, and so we anchor on those expectations. So that's why it's important psychologically. But yeah, anyway, I'll come on to chocolate inflation, very important in our household for reasons I'll make clear in a moment. Economic conditions, labour slack, like I said earlier. So what is labour slack? It's the number of people who maybe are looking for work, but haven't got work. So it's not the same as unemployment. So it's something like a low participation rate. So of all the people that could work, what proportion of them do work? So that's slack. And in a weaker economy, there's not such a demand for workers. There aren't so many roles available, and that's when you get larger slack. And that's what we're seeing in the UK right now. We're seeing more labour slack. There are various ways to look at it. You could look at the number of open roles relative to the number of unemployed people. That's one way. Certainly the Fed looks at it that way. And there are various reasons why it happens. But slack anyway is increasing. So that should help wage growth come down. But of course, it's a painful process, because it shows that there's a lack of demand, and that's part of the weak growth story, which is never good. Hiring and employment momentum are weak, and pay growth, which is elevated, is declining. So that's good news from the Bank of England's point of view. And I'll come on to national insurance contributions in a moment. And then finally, global and geopolitical risks. Yeah, I mean, if there is a slowdown of the global economy due to trade tariffs, political uncertainty, then clearly that's going to have a dampening effect on UK growth, obviously, because we're a very open economy. But also it should dampen inflation, which is the good half of that story. What's really awful is when you get high inflation combined with low growth, stagflation in other words. And the UK does look a bit stagflationary at the moment. Inflation's reasonably high. I mean, not crazy like it was previously, 10%. We're talking about 4%-ish, a little bit less, but still fairly high inflation and very weak growth. So that's my quick summary of what's going on. Let's quickly look at some of those things I mentioned, because I think having a quick scoot through the data is never a bad idea. Don't forget to like and subscribe if you haven't. Obviously, it helps us as a channel, and who knows, you might enjoy some of our other content. And here it is. This is the tweet, they're still on X, from the Bank of England. We've kept rates at 4%, vote 7-2. And this is the shape of the policy curve for the bank rate going all the way back to 2000. It peaked at 5.25. You've seen there's been a fairly steady and careful rate of cuts. Now notice that the cuts are slower than the increases. So the increases were a response to a crisis, which was a huge spike in inflation. The cuts are now trying to address this problem of sticky inflation. So you can see they're trying to keep it restrictive for longer because of this really quite sticky tail in wage growth and inflation. So that's the reason why it's been slower on the way down. This is what it looks like since 1694, which is when the Bank of England was founded. And you can see that we're actually now a long way below the median 5% bank rate that we've had over that period of time. So what's typical over that 300-year period? 5%, and we're currently below that. Always good to have context. If we look at what happened to sterling versus the dollar, so 12 o'clock lunchtime today was when the Bank of England announced that there wasn't going to be a rate cut, and sterling fell versus the dollar. So that's fairly standard practice, fairly standard reaction. If it looks like you'll be cutting in future, then maybe that's the way the market interpreted it, which is that we haven't cut this time, but we'll probably cut next time. But what you'd expect is if there was a cut, it would weaken the value of sterling versus the dollar. But this time around, it's as if the Bank of England had cut rates, I'd say. There was a small fall in UK gilts as well. So this is a 10-year gilt ETF. They fell a tiny bit, so yields increased a little bit as a result of the announcements. But look, everyone was expecting the Bank of England to hold this time around, so no surprises. A lot of it was priced in. What's really worried people is what's happening at the long end of the curve, both in the US, the UK, France, Europe, because that's where yields are really picking up. If we scoot out even further, so this is over the last 2 years, so that you could just see the recent price action or the yield action for gilts. So yields go up, prices go down. So the prices of these long dated gilts have been falling. Whereas at the short end, of course, these respond to monetary policy, and those have been falling as the bank's been cutting. But at the long end, rising. So what's been happening is a steepening of the curve. If we look over a longer period, you can see that we're pretty much back to where we were pre-financial crisis now. So we went from a high and flat curve, which looked like that, to a low and flat curve during the financial crisis. And now the curve has gone back to a high and flat curve, and now it's gone to a high and steep curve. Okay, I'm trying to do this with my arm. We don't spare any expense at PensionCraft. Anyway, you can see that steepening effect here. The red line, which is short-term rates, 5-year rates, not very short-term, but quite short-term, those are falling. The long end, you can see, is moving up pretty rapidly. So various reasons for that. We did a whole podcast about it, Many Happy Returns. You can listen to that. So this is the letter that Andrew Bailey, this is just the first page of it, which he wrote to Rachel Reeves. Dear Rachel, he says. And then he kind of outlines the reasons for their monetary policy decision. And what's quite funny is here in the bottom paragraph on this page, he says, against the backdrop of gradual easing in underlying price pressures in the UK economy, the recent increase in CPI inflation has owed largely to food prices and administered prices, including water bills and vehicle excise duty. Okay. A reduction in total labour cost growth also appears to have been delayed, double negative there, by the increase in employer national insurance contributions. Now, who did that? Oh yeah, it was the government. The government actually increased the NI contributions. And he also talks about pay growth in sectors with a large share of employees at or close to the national living wage. And of course, another policy was to increase that minimum wage. So essentially what he's saying here is the inflation spike is thanks to you because of your policies. The NI increases and the increase in the national living wage, minimum wage. So that was kind of amusing. But still, all of the blame can't be laid at Rachel Reeves's door. A lot of it has been due to energy prices, which aren't under the government's control directly. Maybe they could subsidise it, but that's probably not going to happen given that they're strapped for cash. And these kind of administered prices are things like water bills, which are partially regulated, right? and vehicle excise duty, which is, I guess, set by the government. So inflation, service inflation stays pretty high, 4.7%. Remember, that's driven by wages. Goods inflation was in negative territory. Now it's starting to go positive as well. So, both components have seen at least goods inflation has seen an acceleration, and that is a bit worrying. What's led to the change that we saw in August? Well, transport has gone down. Remember, that's due to energy prices largely. Restaurants and hotels have gone up. Food and alcoholic beverages have gone up. So those are the kind of marginal contributions to the CPI change in August. Now, coming on to the sad story of the household, the Nikisa household, you can see that Laura's developed this habit, which is the Big Daddy pistachio bar, right? So this thing is a beast. When it looks, I thought it was going to break the fridge shelf. It was so big. It does look delicious. I'm on a diet, so I can only fantasize about eating this stuff. But you can see that chocolate inflation in the UK just went completely mad, well above 15% per year. Although it has fallen a bit, it's still very, very high. So certain aspects of food inflation in the UK remain high. And I'm making a joke about this, but food inflation is really important because it hurts the people who can least afford it. People who have the least income, household income, are the ones for whom the food forms the largest proportion of their consumption basket. So that's really awful for those very poor households, food inflation. So that's been a very painful period for the poorest in the UK due to inflation. If we compare UK inflation with other countries, such as the US, Europe, France, Germany, you can see that the UK, which is the blue line here, unfortunately, we're quite a long way above those other countries. Partially, that's due to the energy price cap and the way it works. That is expected to come down, but that's not good to see. The US is the kind of orange line here for their comparable measure, which is US hiccup. Anyway, that's not a great story in terms of managing UK inflation. Anyway, that's my quick potted summary and the reasons for their decision. So let's turn it over to you now, because that's what we do. That was a 20-minute summary of no decision at all. Michael always makes fun of me, my podcast co-host, because he always says, even when nothing happened, Roman manages to talk for a long time. But I think the reasons for the decisions are always quite interesting as well. Oh, I've got Built on today. Look at that. He's not going to want to go downstairs. It's Chilton Biltong. We just had the president go over in a chopper. I tried to see him on the way back, but he went to Luton Airport, unfortunately. So, was it Stansted? So he didn't go over our house. But Checkers is at a secret location nearby. Everyone knows where it is. And so he kind of flew over on the way there, which was quite exciting, which I missed because I was working. But that's a bit of excitement in the Chiltons. And this is Chilton Biltong, Ted. What do you think of that? What do you think? Is it good? Yeah, you like that. Good. We get one more piece up here and then go downstairs, yeah? Yeah, he loves this stuff. Oh, big piece. Big chunky piece. There you go. Let's break it into... Oh, God, I can't... Oh, dear. Dear Lord. Give that a good chew, mate. You should chew that. You're going to choke. You're not bothered. You just inhale it, don't you? There we go. Anyway, back to your questions. Yep, do subscribe, and you go and get your biltong downstairs. Go on. Go. Laura. Come on. She's rattling it. Come on. You go and get your biltong. Good lad. Anyway, yeah. So if you have a question, if you have a super chat, we'll push you to the front of the queue. And if you're one of our supporters on YouTube again, we'll push you to the front of the queue. I'll open the document, which I didn't open earlier. and have a look at your questions. No super chats yet. I'm sure you will super chat. Let me have a quick look. See what we've got. Someone's saying, "Oh, Alex M, greetings from sunny Milan." That sounds awesome. I'd love to be there. I love Milan. Okay. Martin Kesson, will shares go down tomorrow? I've no idea. So I always think if you're the kind of person that needs to know whether shares are going to go down tomorrow, it probably suggests that you've got the wrong investment strategy, because thinking over a one-day horizon is just not going to work. You can't forecast stocks over 1 year, over a 1 day, 1 month, even 1 year period. What you can do fairly well is look at that long-term drift and stay invested for a long period of time and harvest that long-term upward movement. But look, 1 day, 1 month, you may as well flip a coin. Very difficult to forecast. Nobody can do it convincingly. So I wouldn't try. So your strategy really should be around that, harvesting that long-term return, which is why buying a global index fund works for most people. Plus it's easy, all right? You don't have to try and do the impossible, which is forecast markets short term. Next question, Rajaseelan Ganaswaran, also a regular listener. He says rats, same rates. Yeah. Gavin Lawrence, who are the two maniacs who voted for a cut? Let's pull up the MPC thing. I did look earlier, but of course I've forgotten. Voting for the cut. 0.25. Here we go. This is it. Share. And here we are. Make it a bit bigger. All right. Maximize that. Move myself up a bit. So at this meeting, the MPC voted to reduce the stock of government bond purchases. Yes. Where was the... Here we go. 7 members voted in favour of the second proposition. 2 members voted against this proposition. Catherine Mann. Oh, that's for the stock reduction. Let's have a look at the rate. Here we go. 7 members voted in favour of the first proposition, so I think this is the rate decision. 2 members, Swati Dhingra and Alan Taylor, voted against his proposition, preferring to reduce bank rate by 0.25 percentage points to 3.75. So 2 people wanted a cut, Swati Dhingra and Alan Taylor. I don't know if they're standard doves. Maybe those 2 are. Usually you get members of the committee who are often the ones which want to cut or raise interest rates. I thought Megan Green was one of the ones that wanted to cut previously, so maybe she's changed her mind, which is interesting. Anyway, those were the 2 dissenters. But it's good. I kind of like the fact that in the UK we have dissent. Maybe now, given the slow takeover of the Fed by President Trump's staff, maybe that'll happen in the US as well. There will be dissent because it'll be the old regime versus the new regime. So perhaps that will happen there too. But I think it's nice to have that kind of discourse. Plus it makes the notes really interesting to read. If there is some kind of disagreement, often the arguments are quite interesting in themselves. Next question is okay. Boz 47 says Andrew Too Late Bailey. Yeah, because of course Trump makes fun of Powell by saying he's Jerome Too Late Powell. Yeah, because he's too late to cut. What are the predictions? What was the announcements? Rates held. Do you vote 2 votes to cut? And then someone says, because people think our economy is crap. Yeah. I think someone is probably talking about the biltong here. They're talking about it's really nice. I've tried it. Or maybe the chocolate, that kind of jumbo chocolate bar from M&S. And it's £8.50 apparently. Yeah, not cheap. But hopefully the inflation rate not going to stay high for chocolate. Boz47 says, can we ask Roman about gold? Funny you should say that. Gold, any happy returns. Guess what we did on our podcast this week? Brilliant title from Michael, as always. Raging bullion. Is gold a good investment? So, if you want to hear 40 minutes of discussion about gold, why it's good, why it's bad, why you can't avoid it, why you shouldn't avoid it, have a listen to that. And plus it's quite entertaining, I think. We try to keep it light. We certainly laugh a lot and we enjoy recording it. So we assume that's why other people like it as well. I kind of think of it like the live streams. It's a bit more informal, a bit more casual, more interactive. Maybe these are because we have the questions, but it's less formal than the YouTube videos where I'm standing in front of a camera and sitting in front of a camera and trying to get points across as quickly as possible. The podcast is quite relaxed, more of a chat really. So back to your questions. How's your pension transfer? No channel name. This is from No Channel Name. How's your pension transfer cash redeployment going? Are you still drip feeding, DCAing back into 100% global ETF? Well, I mean, I've got, I think it's 60% in equity now, 40% in money markets. So, am I going to speed that up now? No, because we're at all-time highs now. So I should really, strictly speaking, carry on with the drip feed, but that's where I am with the SIP right now. What else have we got? Andy McNeish, Roman and Teddy weren't allowed any. Yeah, quite right. Well, Teddy can't have chocolate because it's not good for dogs. You can certainly have the biltong. Palwi says, I bought ASML a few days ago. That's brave. I think we should also track biltong inflation, according to Andy McNeish. Good point. Paul Chadwick says, are there small and mid-cap funds to invest in? If so, is there a limited upside because successful companies become large caps and move out of the small mid-cap funds? There are small and mid-cap funds to buy. I assume you're talking about the UK. But the UK has them as well. FTSE Russell, I think, has a nice infographic which was shared on our chat application recently, which I can probably find, which talks about the size of various markets. I think it was after I kind of talked about it during one of our Sunday evening calls when members just kind of dial in and ask questions like this, but it's more kind of family oriented because they're our PensionCraft family, so it's quite intimate, unlike a YouTube live, which is people who aren't members of the community. See if I can find this thing. No. Small caps. Yeah, because what someone said was, do I get small caps if I buy one of these global index funds? And the answer was no, you don't. There are almost no small caps in ACWI, for example, because it's mid cap and large cap only. But there's a nice infographic which I'm trying to find from FTSE Russell, which actually shows for the UK market what the structure is. Yeah, this is the one, I think. Yes. I think this was it. For reply. Here we go. So this is our chat application, Mattermost, and this is where we all kind of chat with one another in the community. So this is the infographic I was thinking of. It's great, you know, it kind of shows you the UK market. So FTSE All World, that's the one that Vanguard's global funds track, for example, the FTSE All World Index, that's EM and DM. But notice that it's got no small caps in it and it's got no micro caps in it. If you go for the FTSE Global Total Cap Index, which I don't think anything tracks, that includes everything, including micro caps. If you go for the Global All Cap, it includes small caps but not micro caps. So for a while, I bought a tracker for this index, the Global All Cap, but the fee was pretty high. It was 0.2 something, 0.23, I think. So in the end, I just thought, you know, I'll just stick to FTSE Developed. The fee for that on the tracker from Vanguard was 0.12, so I just prefer the lower fee. And that's the problem if you track micro caps or small caps, because the churn cost is higher, because the bid offer spread on those smaller stocks is larger. That's passed on to you as the investor, so they're more expensive to track. That's why people usually. That's why market cap weighting is such a good idea, because the actual tracking cost is dominated by the large caps, which have tiny bid offer spreads, which is just makes for a cheaper tracking approach. Anyway, so that's our chat application, which you get if you're a member of our online community, which I'd strongly recommend. People find it very useful. Do we have any super chats? No, we don't. Have none whatsoever, in fact, tonight. Oh, we have got one. We have got one. Thank you. This is Simon Scott, who says, given they aren't likely to cut this year, what's the best home for cash now? I'm retired with 50% cash, stay in money funds or into bonds or risk. Well, I mean, I always like to share if I do something stupid. So let me just share my latest stupid action. Cash. Right. Yeah. Okay. So, for my fund portfolio, more than half of it is currently in cash, right? So you'd have thought I'd have switched on the interest choice. There's a little checkbox. So I looked at how much interest I was earning. It was nothing. And then I actually drilled into the menus, and there's actually a toggle. It says, would you like to receive interest on your cash? Which I switched it off, or at least I haven't switched it on. So for the last 6 months or even longer, I've had no interest on the cash I've been holding. So that was really quite annoying. I really did kick myself. Anyway, it's all switched on now, and I'm making returns for that at last. But anyway, just be aware that if you don't check the box, you will not get interest. So that was slightly annoying, actually very annoying. So the rate you get currently is a little bit higher than bank rate with sterling. You can earn 4.05%, and you can actually see how it's split between the different banks and different money market funds. It says if you enable interest, we'll hold your cash in qualifying money market funds and banks. So banks will pay you a bit more than the money market rate because they have credit risk, presumably, and they want to encourage people to deposit money with them. And qualifying money market funds will earn SONIA. So 4.05% currently. If you're in sterling, if you're in euro, much less, 2.2. If you're in dollars, 4.1, a bit more. Swissies, almost zero, unfortunately. 5% in Hungarian forints. If you're in zloty, you get 4%, and so on, right? So also, I think the conversion rates are pretty good, 0.15. So if you've got the card and you're traveling, you can use it as a kind of spending thing. It's quite cool. Anyway, so if you've got cash, you can earn 4.05 on trading 212. If you want to keep it in a money market fund yourself, well, you'll earn the SONIA rate, which from the Bank of England's website is currently 3.95%. So to find this, just so you can see how to do it, Sonia, I type Sonia Bank of England, SONIA, Sterling Overnight Index Average, Bank of England. There it is. And we'll scoot onto that page and we'll click on the Sonia rate. Here it is. Let's have a look at the chart, or graph as we call them. Here it comes. And I think from memory it's 3.95. Let's just see if that's true. Secret. YouTube's waiting. Wow. I think it's Andrew Bailey. He's having to stoke coal into a boiler to get the servers working. Here we go. So 3.97 is what you'd get at the moment. So most money market funds are benchmarked against Sonia, not bank rate. Remember, bank rate's 4. This is a little bit less. So you're going to earn about 3.97 at the moment. And that's true of most money market funds. There won't be much variation between them. Because if you're earning that short end of the curve, the ultra short end, then you'll earn roughly the risk-free rate. So that's your money market fund. The drawback there is, as bank rate gets cut, then you get less interest. Alternatively, you could go for single gilts, and remember those are very tax efficient. If you hold them outside an ISA or a SIP, you don't pay capital gains tax on them. So if you buy the ones which are low coupon, and again, if you're a member of our community, you get these trackers. Let's just pull up the Gilt one, and we'll have a quick look at the yield curve. So you can see that the large circles on this graph are the gilts which pay you, which are most tax efficient. So a larger proportion of their capital, of their total return, is capital gain, which isn't taxed in a general investment account. So let's scoot in just so you can see the examples here. So this big circle, right, TG30, big circle, because the coupon's low, it's just 3/8%, and the income yield is therefore about 0.45%. The remaining part of the yield, the capital gain yield, is about 3.5%. So you're not taxed on that. So that's a very tax efficient one. Another big one, TG33, the coupon is 7/8%. This one, 1/8%, so even more efficient, TN28. Notice how they usually lie below the curve because a lot of people buy them because they're tax efficient in a general investment account. If you hold them inside an ISA or a SIP, remember you can hold them in all three, GIA, ISA or SIP. If you do hold them in a tax sheltered account, well, you don't care about the tax efficiency, so you probably just go for the smaller circles here with a higher yield. But if you hold these to maturity, you lock in a yield on the day you buy it. So that's a reasonable place to park your cash with very high safety. Certainly if you hold it to maturity. If you sell it before maturity, you don't know the price you'll sell it at. If you wait until maturity, it always matures at 100 and you know what yield you'll get. So that's the beauty of bonds, it's certainty and knowing what yield you get, and the locked in yield is what you receive, whereas the SONIA rate, which is the dashed line you can see here, will fluctuate according to central bank policy. And at the moment, remember, the trend is downwards. That's very much the trend at the moment. Despite the uptick in inflation, that's what we're seeing right now. So that's the situation right now with cash investments. You know, those are the three. Straight cash, if it's on a platform where you get paid well for that. Held to maturity gilts, if you're willing to learn about how they work, it's not that hard. It's pretty easy. We've got lots of content on it, both free and paid. Anyway, that's those are the options, I think. And money market funds, you know, those are the three. How are we doing for time? 6:41. I'll answer a few more questions. If you are going to do a super chat, by the way, please do it well before we finish, because what usually happens is it's literally the last minute. I don't see it, and then we carry it forward to the next live, and then I'm not sure that you're going to be listening. But I answer it at the beginning of the next one anyway. Thanks to the magic of Laura Nankin, she's the one that forces me to do it and remembers. Any more super chats? No. Yeah. I noticed in August, the ONS said they were changing UK GDP. Okay, how it's calculated. British overseas manufactured pharmaceutical products will be used. Are you able to explain why overseas pharma is now included? It wasn't something I was aware of. But I guess if you're talking about inflation, no, you're not. I mean, is it possible that those things would have been, they're not a kind of end product? Maybe the pharmaceutical products are not final products. Maybe they're the ingredients for pharmaceutical products which are actually manufactured in the UK, in which case there'd be some value added in the UK. And in that case, it would be reasonable to include it in the UK GDP. But if it's an import, remember, that's subtracted from GDP. So I'm not sure what the reasons for that would be. I've probably got that wrong. But that's not something I'm aware of. I mean, there have been big questions about ONS data and the quality of that data recently. So the jobs numbers in particular, which is worrying because that's such a critical input into the Bank of England's rate decisions. So the Bank of England's in a difficult position because they have to infer things from not very reliable data. Because the wage data is obviously critical to their decision process. Next question, Maat Magufuli says, the nominal inflation is 3.8%, but what do you think is the real inflation rate when you visit the shops? I mean, that's a good point, which is that there is a subjective element to inflation. Not everyone will have the same inflation rate. No two people will, because everybody's consumption basket is different. The CPI basket is based on a kind of average, which is constructed by the ONS, which is difficult to do if you think about it. But it's always changing. Things like flat screen TVs, microwave meals, all of this stuff, duvets. I don't suppose you remember the introduction of the duvet. I do, because I'm old. But these things are added to the consumption basket when they become part of our everyday lives. And they're removed when they no longer form part of our everyday lives. So really there are no two people who have the same inflation rate. But you can do a fairly good job, I think, of working out what the inflation rate is. We all eat. So to some extent, the food consumption basket is similar. We all wear clothes. We all use petrol. Maybe not if you drive an electric car like we do, but there are similarities in our consumption patterns. But I really don't have much time for people who say that it's all con. That this doesn't reflect inflation for the average person, because I think the ONS does a really good job of going to great lengths to try and work out what the average consumption basket is and trying to keep it up to date. So if you think that's not true, just try making your own consumption basket. There was someone who did that recently, where I think it was specifically for lower income households, and I think it was specifically to do with food. But yeah, and I think the ONS actually invited her to come and give some tips about that index, which was interesting. Maybe we should interview her for the podcast. That would be quite interesting to talk to her, to see what she says about inflation and also her experience now that she's actually had to construct a basket with the ONS. Maybe she sees it differently now. It is a very difficult job to do, but she did it off her own bat, which was quite impressive. But yeah, I don't think there's any kind of conspiracy there. And I think the ONS inflation numbers are actually pretty good. That's not the data that's in question. It's the jobs numbers, I think, which are primarily a problem. And also GDP, like you say, has some issues. Right. How are we doing for time? 6:46. A couple more questions, I think. What are your thoughts on BMNR, if any? I like Tom Lee and believed in his vision, so invested. Is it something you're familiar with? I have absolutely no idea what BMNR is. Bitmine Immersion Technologies, is that the one? No idea. No idea. Sorry. Anyway, so I think that's all. We've been together for 47 minutes. I think that's probably enough. Thank you for joining us, and thank you for the brilliant questions as always. Thank you for the super chat, Simon Scott. That's very kind of you. And remember, if you want to join our community, very easy. Just go to PensionCraft.com/membership. You get calls like this every 2 weeks, but it's much more intimate, if you like, because you're members of the community. We get through all of the questions, and you also get access to our chat applications, 200 plus explainers, where members of the community ask me to answer a particular question. They vote on which one I answer, and that way they're by definition relevant to you, probably as an investor. And also there's a chat application, so you can ask a question about anything, anytime. And the community is now really helpful. We have over 1,000 members now, and people tell me they find it very useful. Anyway, you can join anytime. You don't have to join for more than a month. You can end your membership if you don't want to. To learn more about that, PensionCraft.com/membership. I do one-to-one coaching, PensionCraft.com/coaching, and don't forget our podcast, Many Happy Returns, which is absolutely free, just like these sessions. Anyway, thank you all for joining us, and good luck with your portfolios.